All right, let's jump right in. Today, we're going on a bit of an expedition. We're on the hunt for one of the biggest prizes in the investing world, stocks that have the potential to grow tenfold. So let me ask you this. Do you think it's possible to turn $5,000 into $50,000 by 2030? It's a really ambitious goal for sure. But, it's exactly this kind of question that gets investors fired up and fuels that hunt for the next big thing. And look, this isn't just some wild guess or wishful thinking. The search for these 10x returns is actually being guided by some serious financial analysis. And analysts are pointing towards a few key sectors where technology and innovation are creating some really explosive growth potential. So here's our map for today's journey. First, we'll talk about the hunt itself. Then we'll explore two incredibly exciting frontiers, AI and quantum computing. And then we'll dive into the new space race. And finally, we'll wrap up by equipping you with a toolkit to help you evaluate these kinds of opportunities. So what even is a 10x stock? Well, it's pretty simple. It's a company whose value multiplies by 10. The appeal is pretty obvious, right? But finding these gems, that means you have to look beyond the big established giants and into these emerging sectors where that kind of rapid, game-changing growth is actually still possible. All right, let's dive into our first major frontier, the world of artificial intelligence and its even more, let's say, exotic cousin, quantum computing. This is where a lot of analysts believe the next massive wave of value creation is going to come from. And just take a look at the sheer speed of the growth we're seeing here. I mean, we are not talking about 20 or 30%. IonQ, a quantum computing company, saw its revenue just soar by 429% year over year. And Nabevius, which is in the AI cloud space, posted an absolutely staggering 547% growth. These are the kinds of numbers that tell you a major technological shift is happening. But these incredible numbers aren't just happening in theory. AI is being used in some very real ways right now. You've got SoundHound AI, which is automating restaurant drive-thrus. You have Palantir, helping governments and huge corporations make sense of these massive, messy data sets. And then there's Resolve AI, which is putting chatbots to work inside platforms we all use, like Microsoft Teams and Slack. This adoption is happening as we speak. And this quote really puts the long-term vision into perspective. So while AI is definitely here today, quantum computing, that's the next horizon. Analysts are predicting it could become a mainstream business tool by 2030, and that's exactly why investors are paying such close attention to the early players in that space. Okay, let's blast off to our second frontier, the new space race. But the strategy here has totally changed. The focus is shifting away from those old legacy giants and toward a whole new breed of smaller, more agile companies. Let me break that down for you. The old way to invest in space was to look at these massive $100 billion plus defense contractors. But think about it. For a company that huge to 10x its value, it would have to become a $1 trillion company. That is a very, very steep climb. So the new approach is to hunt for these smaller multipliers, companies that just have way more room for that kind of exponential growth. So, who are these new players? Well, across the whole commercial space ecosystem, you're seeing names like Rocket Lab, Redwire, the newly public Arzexis, AST Space Mobile, and MDA Space just constantly popping up on investors' radars. Now, this focus on growth potential has completely changed how these companies are valued. I mean, historically, a space stock might have traded for less than 4 times its annual sales. Okay, now fast forward to today. Even the so-called cheapest ones are trading for over 10 times sales. And then you get to the extreme end, where you see valuations like Rocket Lab's at a jaw-dropping 75 times sales. The market's expectations have, well, skyrocketed. So in a market like this, what's even considered a bargain? Well, this number, 5.8 times sales, that's the valuation for Redwire. It's seen as a more grounded valuation. And that's maybe because Redwire builds critical space infrastructure. The picks and shovels of the space economy. That makes it seem a little less speculative than companies that are focused only on those higher risk ventures. Okay, so exploring these frontiers is incredibly exciting, right? But let's be real, it's also super risky. So it's time to pivot a little bit, to ground all this hype in some financial reality. Let's open up the investor's toolkit. One of the best tools for this is something called the Rule of 40. It's a really simple but powerful metric, especially for software and subscription-based companies. It's designed to check if they're balancing that super fast growth with actual profitability. It just cuts right to the chase of how healthy the business is.
So how does it work? You're going to love this. It's actually super simple. First, you just find the company's annual revenue growth rate as a percentage. Then you find its EBITDA profit margin, which is basically just a measure of its operating profit. You add those two percentages together. And if the final number is over 40, the company is generally considered to be on a really strong sustainable path. And what's really interesting is that research from Boston Consulting Group shows this clear pattern. Companies that do well with the Rule of 40, they call them keepers, have high customer retention. So for example, a keeper might have 30% revenue growth and a healthy 15% profit margin. Add that up, you get 45, a clear pass. On the flip side, you have the underperformers, which they call leaky buckets, and they just struggle to keep the customers they bring in.
And the crucial metric that really separates these two groups is something called gross revenue retention, or GRR. All this measures is how much revenue a company keeps from its existing customers year after year. It's a direct signal of how loyal those customers are and how essential the product is, its stickiness.
So here's the bottom line, the crucial point. Explosive growth is exciting, yeah, but sustainable, efficient growth is what really builds long-term value. The best performing companies get this right. They build a strong foundation of customer loyalty. They don't just keep pouring water into a leaky bucket, they make sure the bucket is solid first. And that brings us right back to where we started. As analysts point out, turning 5 grand into 50 grand is tough. It's no easy feat. But the potential is there because the businesses in these emerging sectors are already expanding at these incredible speeds. So we'll leave you with this question to think about. As an explorer in this new landscape, the real challenge is figuring out how to balance that electrifying, groundbreaking potential with the simple, fundamental performance that tells you a business is healthy and built to last. Finding